Last night, I mean, first of all, President Trump, he definitely went through his checklist. He talked about, talked about unity. He talked about unity, especially around drug prices, unity around immigration. Just unity was strong. And I think the key point he talked about is the economy. And we foresee him, President Trump, running on 2020 re-election campaign on the economy. So his comment about the 2020, the hottest economy in the world made sense. I think overall, what we've been telling our advisors today is that we were cautiously optimistic about the markets and about the economy, but now we're modestly optimistic. And there's four main reasons why. First of all, the Fed has turned from a very hawkish stance to a very dovish stance. You're seeing this in Fed governors speak, talking about patience and close to interest rate neutral. Second of all, we feel the trade war is a limited resolution that we think it's going to be solved pretty soon. You're seeing all the branches from both sides. You see the need for the U.S. and China to end this trade war soon. It's affecting our stock market like it did last quarter. The S&P was down 14 and change. You're seeing some of the weaker economic data, like services came out yesterday. On the Chinese side, demographics, their transition from a manufacturing to a Chinese economy is really being hampered by trade war. Third of all, the stocks last quarter were weak. One concern was the 2019 recession. We don't see that. Job growth continues to be very strong. And then the last point is that look at corporate earnings. Going into this quarter, corporate earnings, everyone was very skeptical, but we've seen about half of the S&P 500 release earnings. 70% have beaten expectations by 3.5% from an earnings standpoint. 62% have beaten from a revenue standpoint by 80 basis points. We are optimistic for the first half of this year about the markets.
Going from cautiously optimistic to modestly optimistic seems like a very nuanced downshift in assessment. Paul, I'm not sure if you're cautiously or modestly optimistic or where you fall on the optimism scale, but where are we here with the averages close to 200-day moving averages?
So I think to what Gene was saying about earnings, this earnings season, last quarter, third quarter earnings season in October, great earnings reports we were getting from companies, and the stocks were getting slammed on the news. This quarter, we're getting earnings reports, not as strong as they were, not as strong as relative to expectations, and investors can't get enough of these stocks. Their stocks are being bid up. Yeah. They're opening up, but more importantly, then they're getting bid up after the open, and they keep going up. So the average stock that reports earnings this quarter has gone up over 1%. We haven't seen that type of positive reaction since the first two quarters of 2009. And that's coming on negative guidance. For every one company raising guidance, we're seeing two companies lower guidance. Skyworks Solutions last night reported weaker than expected earnings, revenues, not so great guidance. The stock is up this morning. So we're seeing investors are willing to look past this, and I think we saw sentiment get so washed out that it doesn't take much to light a fire.
Well, to that point, I mean, to me, the persistence of this rally and the fact that it just seems to kind of find a bid through the course of each day is mostly a measure of how ill-positioned investors were for it, right? So I guess how far can that take us at this point? Because the last few days have felt like 2017, where in the absence of another influence, the market's just going to go up 0.25%.
Right. So we're seeing this positive backdrop from earnings. So, when earnings season does wind down, then what do we focus on going forward from there? We'll see. But, we're seeing the market just drifting positively higher throughout the trading day. And that's a strong environment.
In that kind of market, though, if it's a market that's moving based on positioning beforehand, should you be invested to take advantage of these upswings in the stocks that were beaten down the most? Semis, to that point of Skyworks Solutions, gotten totally crushed, right?
Right.
So the positioning was very poor on that side, and here we are, where you're just climbing a wall of worry every day.
Well, listen, my view is that you really want to be in the more cyclical sectors of the markets, financials, industrials, technology, energy. Those are the places. Last year, economic growth was much better than expected. Earnings growth looks like it'll be up 22%. And yet the best performing sectors were utilities and consumer staples, right? And just, another reminder, with enough inside information, you could go broke, in a year. To me, liquidity is still the main driver of risk assets. And while we don't have the TINA, idea of there is no alternative, you are in a situation, cash is certainly an alternative now, there's no two ways about it, with short rates where they are. But with the Fed sidelined, in my opinion, not just because of inflationary expectations here, but because of what's happening abroad, you're not leaving people a lot of other options. And it's, in my opinion, I agree with Gene. I mean, I think the chances of a recession in the United States before the 2020 election are quite low. And I think that has changed the mixture a little bit.
You know, and I think one of the things we've been watching to see if this rally is going to start running out of steam, what led us on the way down? It was semis, home builders, and emerging markets. What stabilized before the market? Semis, home builders, and emerging markets. And those are doing well now. And as those sectors continue to outperform and hold up well, I think that's a tell for the market. And emerging markets are coming out of a massive period of underperformance. And if you're going to see an easier Fed, weaker dollar, it should help the sector.
So, Gene, how are you positioned for a modestly optimistic outlook on the economy?
So I think, thank you. I definitely agree with a lot of what was said earlier. I mean, you look at the January, we saw small cap, a more aggressive sector, asset class outperform large cap. We've seen growth outperform value. NASDAQ's outperformed the Dow. So it's positive there. How, from a position standpoint, we like the cyclicals. So we like technology. I think, technology, given the ability to improve productivity, given the fact that that artificial intelligence is the future. You see it everywhere. We like healthcare. M&A activity in healthcare is huge. Also, you look at earnings. I think healthcare, from a revenue standpoint, has been the biggest or second biggest beat compared to earnings or revenue estimates. And the third area we like is consumer discretionary. Consumer discretionary, think about this. Gas prices are down significantly. This is great for consumers. We will be getting tax refunds very soon. Interest rates have moved a little bit lower. So healthcare, technology, and consumer discretionary are our favorite sectors right now.